Welcome. My name is Dariusz Trojanowski. This meeting is held in cooperation with Foundation Pomerania Institute of Property Expertise, which received funding from the Erasmus Plus project. I would like to thank the Foundation for the opportunity to present the result of my research. I should tell you something about myself. I am a real estate professor. I have been working for more than 20 years at the University of Gdańsk. I am also a professional real estate appraiser and consultant. I specialize in the valuation and profitability assessment of commercial real estate. Today, I will tell you about the result of my scientific research, but also about my professional experience. The main topic of the lecture, of the presentation, is application of weighted average cost of capital to commercial real estate valuation. The aim is to show you how to determine WACC, weighted average cost of capital, based on Professor Damadaran's data, and present you proposal to convert WACC into a discount rate used in the valuation of property. I have prepared an Excel model for you, which we will use to determine the discount rate. I have also prepared an ebook with a theory of this method of determining the discount rate. You can download the Excel model and the ebook from the Foundation's website. I encourage you to download the Excel model and use it with me during this training. Now I will turn off camera to avoid lags. As this meeting is for real estate professionals, so I will not be explaining the basic of the income approach. However, let's us remember that valuation in the income approach is a process. This process generally involves estimating the income from the property and the rate of return. I will only talk today about one element of this process, the discount rate. Let's start by discussing selected methods to determine the discount rate. The best way to determine the discount rate is always the one based on market evidence. If we have current data from the local market, then it's best to estimate the rate of return based on this data. Often there is not enough data from market transactions, and we have to look for other ways. In Poland, appraisers most often use the additive method. This method is a sum of risk and generally based on the risk-free rate. Valuers very often do not calculate individual risks, but assume them based on the knowledge and understanding from the local market. The disadvantage of this method is its subjectivity. The methods used in corporate valuation seem to be more objective. These methods include capital asset pricing model and weighted average cost of capital. It's very important for you to remember that we cannot directly apply this method to determine the discount rate for commercial property valuation. CAPM is used to discount cash flow to equity after debt service. This rate tells us the cost of equity and is needed to determine the WACC. The WACC is used to discount cash flow for all capital providers. Free cash flow to firm is cash flow before debt service. In property valuation, the valuer discounts net operating income. This income is before debt service too. The WACC is therefore a better solution for property valuation than the CAPM. Still, net operating income is not the same as free cash flow to firm. For this reason, the application of the WACC to property valuation needs to be adjusted. When we determine the discount rate for a corporate valuation, we often use data from the stock markets. Real estate is not as liquid as stocks on the stock market. For this reason, an adjustment is also needed. I have already told you that the WACC is better solution than the CAPM, but we need the CAPM to determine the WACC. For this reason, I'm going to tell you about the determination of the CAPM. CAPM is the cost of equity. The formula includes risk-free rate, market risk premium, and beta equity ratio. Let's talk about the elements of the formula. In practice, government bonds yields are most often used to determine the risk-free rate. For the valuation of real estate, long-term bond data should be used. Ideally, they should be fixed rate bonds. In my country, we don't often have such data. That is why we use 10-year bonds. You can find information on government bond yields in several different sources. We will be using the information on the European Central Bank website today. As you can see, the risk-free rate for Germany is 2.21. For Poland is 5.28. We use data from June to be consistent with other data. From June, the risk-free rate for Germany is 20.48, and for Poland 5.73. The next element of the CAPM formula that we need is the risk premium. The risk premium relates to the country in which the investment, the property, is located. We can find information about the risk premium on the site of Professor Damodaran. Now I will show you how to find this data. We have to go to data. As you can see, there is current data and historical data on this side. This data is divided into different regions. From this page, you can download the Excel files with the data you need. Let's go to the files I downloaded earlier. Now we can see risk premium for Germany. It is 4.12%, and for Poland it is 5.15%. Let's get back to the presentation. How the Damodaran calculates this and other indicators I have generally described in the ebook, but I encourage you to read Damodaran's books on the subject or watch his videos on YouTube. The beta ratio shows what the risk level of the evaluated investment is in relation to the risk premium for country. Damodaran determines beta for specific sectors in different regions of the world. General interpretation of beta's levels are described here. Damodaran shows the leverage and unleveraged betas for the sectors. We need a leveraged beta, but as you can see in the formula, a tax rate is needed to determine it. Unfortunately, Damodaran doesn't not calculate sectoral betas for individual countries from Europe. The betas include the tax average for the European region. I believe it is best to take the unleveraged beta from Damodaran's website and calculate the leveraged beta using this formula and the tax rate for the country in which the investment is located. As you already know, the concept of determining the discount rate, which I call the adjusted WACC, is based on the transformation from corporate valuation data to commercial property valuation. I'm not thinking on any particular company, but of a sector that is closely connected with the real estate market. We need to look for companies, or rather sectors, that have a direct link to the property market. As I said before, we will rely on Professor Damodaran's data. In the data, we can find many sectors that have a relation with real estate market. In my opinion, the best solution is to use REIT data. Let's talk about what REITs are. In the literature, we have many definitions of this object. I will read one of them. REITs are special purpose vehicles or investment funds created to invest in the commercial real estate market for rent. One of the reasons for the creation of REITs was to enable people to invest in capital incentive commercial real estate. There are many regulations, including tax regulations, dividend policy, to make investing in REIT similar to investing in real estate. So this is what we were looking for. On this slide, you have a more detailed definition of REIT. All the indicators we need will refer to the REIT sectors for Europe. Now let's go to Damodaran's data file. We need information on unleveraged beta corrected for cash for REITs. Unleveraged beta corrected for cash. And now we are looking for REIT. REIT, it's here. The beta is 0.47. Let's get back to the presentation. Now we know how to determine the CAPM. Let's talk about determining the WACC. The WACC includes the cost of debt and the cost of equity. To calculate the WACC, we also need a proportion of debt and equity in the financing of the investment. Information of this you can take from Damadaran's website for the REIT sector. As you can see, the formula includes a tax shield on interest on debt. The cost of equity is determined by the CAPM. The proportion of debt and equity, the income tax rate you can find on Damadaran's website. Let's talk about the cost of debt. The best solution is to take the cost of debt as the corporate bond yield for real estate companies in the country. In Poland, there is not enough data for such a solution. For this reason, I propose to calculate the cost debt based on Damadaran's data. Damadaran shows the calculate cost of debt and cost of equity for REITs for Europe. This is average levels. Let's go to the Damadaran's data file. As you can see, in this cell, we have cost of equity for REIT. And this cell, we have cost of debt. Now, we can calculate ratio, relation between cost of equity and cost of debt. Relation between cost of debt and cost of equity. 66.78%. Let's get back to the presentation. From my observation, the ratio of the cost of debt to the cost of equity is a good solution. The ratio you can multiply by the result of the CAMP model, and you will get the cost of debt for the local market. After this introduction, I will tell you about the adjusted WACC. On the slide, you can see the formula for adjusting the WACC for property valuation. We will use 3 ratio to adjust the WACC for the valuation of the company to the valuation of the property. 2, and 3. The procedure for determining the discount rate for commercial property valuation includes 4 steps. The first, determination of the CAPM for investments in real estate companies, listed companies. The next, determination of the WACC for investment in real estate companies. The next, adjustment of the WACC to the property valuation to the real estate market. And the last one, adjustment of the discount rate to the specific risk of the valuated property. Damodaran calculates all indicators based on information from public companies. Listed shares can be sold more easily and quickly than commercial property. For this reason, we must include a value discount. Damodaran notes that in practice, it is difficult to calculate the liquidity discount. It is usually assigned arbitrarily, usually at 25 to 40%. If we want to use these value discount factors to adjust the discount rate, we have to change this factor to 1.25 or 1.3. In my model, I recommend a ratio of 1.25 for typical properties such as office and 1.3 for atypical properties like factory. The next problem refers to the result, the income which will be discounted during the valuation. As we know from before, net operating income is not the same as free cash flow to firm. For this reason, the application of the WACC to property valuation needs to be adjusted. We have to calculate adjustment ratio. I recommend you calculate this indicator based on the data of the valued property. This table shows an example of the calculation of this indicator. We need to calculate the net operating income and free cash flow to firm for the valuated property. Then we need to divide net operating income by the free cash flow to firm. This is how we will calculate this indicator. From my research, calculations shows that this ratio for typical properties is between 1.2 and 1.3. On this slide, I show you once again the formula for adjusted WACC. As you can see, we can identify two main parts. The first part of the formula, or rather its result, is the diversified discount rate for the commercial property market in the country. This is a diversified rate and thereover cannot be used to value a specific property. This rate can be used as a benchmark. How does it differ from the prime yield? The prime yield refers to the best property in its category, for example, for office in Warsaw. The diversified rate is an average rate and refers to all sectors of the property market and all locations in a country. We know how to calculate the diversified rate. Now let's talk about adjusting it to the specific risk. The indicator refers to sector, general location, detailed location, standard, lease term and quality of tenants, technical condition of the building. I remind you that we already have the diversified discount rate for the commercial property market. The rate includes all this risk, but at an average level. The risk of property valuated must be estimated. The next step is to adjust the rate to the risk. I will show you some example of how to do it. In my opinion, one of the best solutions is to use information about prime yields. We can find this information in the reports of consulting companies. The table shows prime yields for the shopping center sector for individual German cities. The data show differences due to the risk of the general location. We can calculate the deviation from the average of individual city, assuming the ceteris paribus principle. How to do it? In the first step, we need to calculate the average yield. In the next step, we can calculate the deviation by dividing, for example, the yield for Düsseldorf by the average yield. As a result, we get a deviation for the location Düsseldorf. This means that the risk of investing in Düsseldorf is 8.11% higher than the average risk. If we do not have information on prime yields, capitalization rates, we can use the difference in rental rates. In Gdańsk, where I am from, there is usually not enough information about prime yields for specific office location. We have information about rents of different locations. We can try to use data from office building in Gdańsk from different location. The way of calculating the deviation is the same, but you need to insert a minus sign into the formula so that the best location has a lower risk, a lower rate of return. And now we will see the model in Excel. We will try to determine the discount rate for a shopping center in Berlin and an office building in Warsaw. The model contains 10 sheets. The Data tab is the main tab in the Excel model where we change the basic data. The WACC sheet contains calculation and you can print it and attach into the valuation report. Red sheets show the assumption and calculation of other indicators related to specific risk, growth rate, and relation between not operating income and free cash flow. Let's go to the Data tab. As a general rule, you can change the data in the white cells in the model. In the Data tab, we insert or select data for the estimated property. Try to determine the discount rate for a shopping center in Berlin. I am now deleting the data and we will search for information on Domadaron's data. Risk-free rate for Germany is 2.48%. This information you can find on European Central Bank website. I have the data files from the Domadaran website and now we will use them to find information about equity risk premium. Go to the file. We need information about total equity risk premium. We have to find Germany. The factor is 4.12%. Now we need information about beta. Go to the next file. We are looking for information about unleveraged beta corrected for cash. For REIT sector, it's line 73. The beta is 0.47. When we estimate WACC, we need information about weight of equity. Go to the file with Domadaran data. As you can see, we have information about weight of equity. Equity divided by sum of debt and equity. Go to the REIT sector. And we have information about this factor. It is 55.07%. Go to the model. Now we need information about corporate income tax in Germany. I know that it is 40%. The next step, it is calculate the relation between cost of debt and cost of equity. Go to the file with Domadaran's data. We have information about cost of equity for REIT sector for Europe, for all countries in Europe. And here we have information about cost of debt. Now we can calculate the relation cost of debt divided by cost of equity. I copy this information. Okay. Now we have to choose a liquidity ratio. Shopping center, it is typical properties. This ratio, it is 1.25%. The next step, it is to estimate the result adjustment ratio. Go to the assumption net operating income, and we have to find information about shopping center. In these cells, you can change the data of property valuation. As you can see, the result adjustment ratio is 1.4. Let's go to the data. 1.4. Now we have to choose information about valuate property. It is shopping center in Berlin. Location class, the best class, and order is correct. In line 22, we have to change currency. And now we have to go to assumption WACC. This part of table refers to calculation capital asset asset pricing model for the real estate investment. As you can see, the result of this calculation is 5.52%. In the line 21, we have result of calculation WACC for real estate investment. It is 4.2%. In this line, we have information about discount rate for real estate market. As you can see, it is 7.35%. In this part of the table, we have information about specific risk of valuate property. Finally, the result of this calculation, discount rate for the valuated property based on adjusted WACC, is 6.83%. If you would like to compare this discount rate with, for example, the prime yield, then we need to adjust it for a growth rate. We have to go to the appendix growth. In my opinion, the growth ratio is in a stable market should be close to the geometric average of the projected inflation rate. In this table, we have information about inflation from central bank. As you can see, you can adjust it if you think it should be different. Let's go to the WACC. Now we have information about capitalization rate. It is 4.78%. Colliers estimate prime yield for shopping center in Berlin, and the estimation is 5%. Now you can compare this rate. Let's go to the data. Now we try estimate discount rate for office building in Warsaw. Risk-free rate for Poland is 5.73%. Equity risk premium, Domadaran estimate for Poland, it is 5.15%. Beta is the same. We have to change tax rate. In Poland, corporate income tax is 19%. Liquidity ratio is correct. We have to change adjustment ratio because now we are estimating discount rate for office building. Let's go to the appendix net operating income. We are looking for office building. We have office building, and the factor is 1.23. Now we choose information about valuated property. Office building in Warsaw. We have to go to appendix location, and we have to change information about prime yield in this table. I copy information about prime yield for Poland to the first table. Now we go to the data, and now we have choose Warsaw. The title, location, building standard, and other risk is correct. We have to change currency. And now we can go to WACC appendix. The discount rate for valuated property for office building in Warsaw is about 9%. After the correction of growth rate, we have capitalization rate. This capitalization rate is 6.23%. We can compare this. We can compare this capitalization rate with Collier's estimation. Warsaw office prime yield is 5.75%. As you can see, there is a difference, which may be due to difference in time or the result adjustment factor, for example. Let's go to the presentation. This is all I have prepared for you. I encourage you to use the model. If you have any question or comments, you can reach me at this email address. Thank you very much.